Another day, another story. Mergers and acquisitions are transactions in which companies combine or one company takes over another. These transactions can take many forms, such as a friendly merger, a hostile takeover, or a leveraged buyout. M&A activity can be driven by a variety of factors, such as strategic objectives, market conditions, financial considerations, and shareholder pressure. In this video, we will explore the financial and strategic considerations involved in mergers and acquisitions, including valuation, financing, and post-merger integration. Valuation is the process of determining the worth of a company. In the context of M&A, valuation is a critical factor in determining the price that one company will pay to acquire another. There are several methods of valuation, including the discounted cash flow method, the market multiple method, and the comparable company analysis method. The discounted cash flow method involves estimating the future cash flows of the target company and discounting them to their present value using a discount rate. The market multiple method involves comparing the target company to similar companies in the market and using their market valuations as a reference point. The comparable company analysis method involves comparing the target company to a group of similar companies and analyzing their financial ratios. Financing is another important consideration in M&A transactions. The acquiring company may use a combination of debt and equity financing to fund the acquisition. Debt financing involves borrowing money from banks or other lenders, while equity financing involves issuing new shares of stock to investors. The choice of financing will depend on a number of factors, such as the cost of capital, the availability of financing, and the level of risk that the acquiring company is willing to take on. In some cases, the acquiring company may also use cash reserves to fund the acquisition. Post-merger integration. Post-merger integration refers to the process of combining the two companies after the acquisition is complete. This process can be complex and challenging, as the two companies may have different cultures, systems, and processes. Successful post-merger integration requires careful planning, clear communication, and effective execution. Key areas of focus may include organizational structure, technology integration, talent management, and customer retention. Strategic considerations. In addition to financial considerations, M&A transactions are often driven by strategic objectives. These objectives may include expanding into new markets, acquiring new technology or intellectual property, diversifying the company's product or service offerings, or gaining access to new customers or distribution channels. Before entering into an M&A transaction, companies should carefully consider their strategic objectives and evaluate the potential benefits and risks of the transaction. This may involve conducting a thorough analysis of the target company's business, financials, and market position, as well as assessing the potential synergies and integration challenges. In conclusion, mergers and acquisitions can be complex and challenging transactions, requiring careful consideration of both financial and strategic factors. Valuation, financing, and post-merger integration are all critical elements to consider when planning and executing an M&A transaction. By carefully evaluating these factors and developing a clear strategy, companies can maximize the potential benefits of an M&A transaction while minimizing the risks. Thanks for watching.